Folks, it's Dave Burrows, Chief Strategist and President here at Barometer Capital Management. I want to thank you all for joining us today. I'm here on my own today without my regular co-host, Pamela Hastings. So I'm going to do my best, but lots to talk about today. Of course, the CPI data came in this morning at 4.0%, down from 4.7% year over year last month. That's 11 straight declines in the CPI data. Of course, CPI came at 5.3%, just about exactly where it was expected to come. But it makes it awfully tough at this point, I think, for the Fed to raise rates tomorrow. And maybe the market's been sniffing that out over the last little bit, because certainly we are seeing some changes in the market internals and things that we've been watching for over the last little while. So let's just sort of kick off as we generally do from a high level. This is S&P going back to 1980. We're big believers in understanding the type of market that we're in. Of course, the 80s and 90s was a secular multi-year bull market made up of a number of tactical bull markets and bear markets along the way. The period that people are always so afraid of are periods like a secular bear market like 2000 through 2009, which had two really significant sort of generational declines of over 50%. Not seeing anything of that kind at this point. Since 2013, when we exited that bear market, we've seen a number of contractions, and probably the worst and longest one was 2022, starting in January, and seeing a low in October of that year, about 10 months. And we're 18 months into this now. We're about 8.6% off the high for the S&P. The worst point was down 27%. That is sort of in line with the setup going into a fairly difficult recession. But at some point that gets discounted. People have a lot of time over 18 months to reposition. And there's been a ton of repositioning. A lot of money's come out of equities. A lot of money's worked its way into bonds. Generally, the consensus view is not the right one. But we did hold the rising 200-week moving average very successfully. And it's now been 8 months since the low. Markets have over 20% off the low, and that's an important number. But time is our friend. The longer this goes on, the less likely it is that we have another leg lower. Our view has been now for months that October was the low. We pointed out last week that there had been a very big broad day on the Friday before last, an 11 to 1 up day. The Russell 2000 that had been significantly underperforming the market also had an excellent day, a 2 standard deviation day higher and holding at important levels. And here we are with the S&P now trading basically at a 52-week high. So I think that this is important. We talked a little bit about statistics last week, when the market was 20% off the lows going back to 1950. 12 months out, 100% of the cases, the market was higher, an average of 28%. We said we wanted to see a broadening out take place. We know that when the market's been up more than 7% on day 100, the 1-year returns generally were very, very strong, and things finished out pretty strongly. We highlighted over the last little bit that we have been through a 12-month period where actually global stocks have outperformed US stocks. And that probably is a little bit of a structural shift. When that takes place, it tends to be that it goes on for a period of years. And there's no question, while the US market is performing well, and we're going to talk about breadth later, we've seen the breadth of the equity advance expand geographically. And certainly we are seeing some things we haven't seen in a long time. Japan, this is the DXJ, which is a currency hedged ETF. We came out of a multi-year difficult period, about the worst bear market in the world. And while the US market was selling off, the DXJ did not. And as the US market has started to improve, you've seen a marked acceleration in the Japanese market. Just to highlight it, 1991 to 2020, a horrible bear market. And this marks the exit. And this is happening on volume, it's happening on breadth, and we are making 30-year new highs. So that's Japan. India, also interesting, coming out of a multi-year bear market. resolving higher. We talked last week about how many flag patterns or pennant formations we had seen resolving to the upside. There's Mexico coming out of a multi-year bear market, trading at new highs. Argentina trading at multi-year new highs. We could go through a whole bunch of markets. We've seen outperformance in general in EFI and Europe over the course of the year. And one of the common characteristics is a bunch of these markets have fairly economically sensitive sector makeups, which would fly in the face of concerns around a deep recession. So things just to keep in mind. But I do care that the equity breadth geographically has been expanding. And we'll talk a little bit about sector breadth. If we go through this quick chart, and we did last week, trend strength versus momentum, a bunch of global markets at the top end here. Taiwan notably acting really, really well in the back of Taiwan Semiconductor, of course, the big chip manufacturer to NVIDIA and others. From a fixed income perspective, this is a chart we've been putting up for a long time. We probably have to update it. But the important point is that we probably saw a generational low in yields in 2020 and a structural shift to a rising real yield environment. You can see it very clearly on this 10-year yield chart, 1981 through 2020, the reversal above all the moving averages. You can see the really long-term moving averages, and these are monthly moving averages shifting now higher. And after consolidating, actually yields aren't coming down, they are staying firm. There's the TLT, the 30-year US Treasuries ETF, series of lower highs, and certainly nothing reversing here to the positive. So we've been short this for quite some time. We do think we're in a bond bear market, despite the fact that we've seen massive flows into fixed income, higher yields looking attractive to a lot of people who are concerned about, economic activity. It's not been a fruitful exercise. So outside of taking advantage of some short-term yields, maybe as a replacement for cash, fixed income has not been a fruitful add to many portfolios. Bond bear market in place. This stocks versus bonds, S&P versus the TLH. You can see re-accelerating stocks versus bonds. So continue to believe stocks are in a structural bull market. We've been through a tactical bear market or a cyclical bear market, and we're seeing stocks re-accelerate versus bonds. And at some point, it's very likely some of the folks that have moved money to fixed income will capitulate and start moving money back to equities. When we look at commodities, commodity reversed a very long bear market that started in 2008 and 2020. In the course of time during the tactical bear market in stocks, commodities have certainly consolidated. But importantly, if you take 2022-23, commodities are up over the same period that stocks were down. And considering the veracity of the Fed's tightening and the global tightening from central banks, the fact that commodities have been as resilient as they are through that piece is significant. And we are now reaching the apex of this pennant formation. My guess is likely commodities resolve higher as the Fed signals that they may go on pause. There's the agricultural commodities ETF. It already has resolved higher out of this pennant formation. We've seen it in other areas. We've seen uranium reverse higher and come out of its consolidation. Natural gas producers, and of course, natural gas has been really weak, has resolved higher out of this pennant formation that they've been in. Much of our natural gas exposures actually really started to show some strength, even relative to oil producers. But again, this is, I think, a series of foot soldiers joining an army, breaking out of these consolidation patterns higher. And they're significant because the bases and the bear markets that they've been through are significant. It's fair to say these things are underowned relative to some things that are overowned and probably don't have as much upside. If we look at commodities versus bonds, again, an asset class comparison, commodities versus bonds starting to break out of this pennant formation. So we think we're in a bull market in stocks globally. We think that we are in the very, very early stages of a commodity bull market, and it has been on pause, certainly while the Fed was raising rates. But if we get to the point where the Fed takes a pause, we think that the lid can come off these things. On the other hand, things acting like bonds, like REITs, continuing to weaken relative to stocks. And these are places that people have hidden, thinking that they're defensive and they got a great yield, not acting well at all. So US dollar peaked in October when the stock market bottomed, made a lower high in December, made a lower high in March, made a lower high in May, and now trading below these falling moving averages. I say this because the US dollar really is correlated to certain groups. So if we think about the things that got hurt while the dollar was rising, and then things that tend to do well during a falling dollar, they're different things. So let's just go back and take a look at the period after 2000. US dollar versus the basket of world currencies versus pound, euro, yen in particular, fell fairly dramatically in the period from 2002 through 2009. Let's look at what rallied during that period. Well, emerging markets rallied sharply all the way through that period. Commodities rallied sharply all the way through that period, whether it was energy or gold or copper, all of them strong movers. Now, these are the groups that have set up with big bases and are starting to come out of pennant formations as the US dollar is starting to weaken. So I think it's important to watch these relationships. Now, we don't believe in being everywhere. It's a dynamic world. Our job is to understand it and make sure the portfolios are aligned. We start with a top-down process. My focus is macro. We take all of the various asset classes that we can look at for our mandates: equities, fixed income, global stocks, commodities, currencies, and real estate. We take all of the various industry groups and subgroups and put them through a series of tests to try to identify groups within the market that are showing positive price characteristics. And specifically, we're looking for expansion in breadth, areas where there's broadening participation. Those become the groups we like to focus in. We run a bottom-up process where our fundamental team, which are made up of folks that very specifically look for rifle shot opportunities, starting with a very broad universe of securities, looking for a combination of about 20 factors that point to acceleration in the underlying business model, and where we can find positive fundamental change that is technically supported, and they line up in groups where we're seeing expanding breadth. Well, that's where our portfolio should live. Now, nice to think that they would be perfect all the time. It's definitely not. There's lots of mistakes that we make. And so the most important part of the job is to make sure we're pruning the portfolio regularly and making sure the portfolio remains relevant. And so we run a very disciplined selling strategy where we run stop losses on all of the positions. Tricky in a choppy transitioning market, but once things start to trend, it tends to be very fruitful. So let's just talk quickly about where we are seeing expanding breadth and maybe where we're seeing deteriorating breadth, those areas of more risk in the market. Okay, so from a leadership perspective, 2 weeks ago, we highlighted the fact that a very narrow number of companies were beating the market. If you took out the 6 or 7 biggest stocks in the S&P, the rest of the market, in effect, was losing money. And that was not something that could continue on. So either you were going to see those big stocks lose their traction, or you were going to start seeing a broadening out. When we looked at breadth 2 weeks ago, percent of stocks in uptrends in the US was falling. Percent of stocks in uptrends in Canada was falling. The short-term indicators we look at, percent of stocks above the 50-day moving average, percent of stocks with positive momentum, percent of stocks above the 150-day, all were showing some weakness. And we said we need to see some change. Last week, we highlighted that a bunch of the short-term indicators had turned positive. And when we sit today, all of these indicators are green. So percent of stocks in uptrends in the US, if you take all stocks, is positive. Percent of stocks in the NYSE in uptrends expanding. Percent of stocks in the S&P 500 in uptrends expanding. Percent of stocks in the mid-cap index or the small-cap index expanding. So really across the board, we're seeing improving breadth in the US. Importantly, while the US went through a period of bumpiness from March through May, globally, breadth remained very resilient. And the percent of stocks trading above the 50-day moving average, they're positive. We saw Canada turned positive on some of the short-term indicators this week. And quickly, we're seeing change take place as the equity rally is broadening out. What was a massive difference between the equally weighted S&P and the market cap or largest companies was significant when we go back over the last 30 years, about as narrow as it's been. We have had these changes take place that we highlighted last week in the Russell. So Russell 2000 is up 11.7% since the low breadth point in early May. That's a significant change. So let's look at leadership. As of the 26th of May, the average sector had 35.9% of stocks in uptrends. All of the groups in small letters were showing some weakness. Let's fast forward to today. 41.5% of stocks in the average group are in uptrends. So that's a significant change. You'll note that virtually all of these groups are in capital letters. And so we're seeing a broad shift to the right, or percentage of stocks performing well, expanding, not just in a couple of groups, but in a lot of groups. And I can tell you that we are not yet at a normal distribution. And in fact, this can move all the way down here to the right where we get a very high percentage of stocks in uptrends, but that could take weeks or months. So let's just talk leadership. We've talked for a little while now about, since the beginning of the year, large cap tech is of course led. This is the XLK, which is made up of, Microsoft, Apple. Well, each of those are 23%, NVIDIA, Broadcom, Cisco, and so on. Now, we do have Microsoft, we do have Apple, we do have Broadcom, we do have Salesforce, we do have NVIDIA. Those are among the largest positions in the firm. We also have significant semiconductor exposure, which we've talked a little bit about. It's really been rising relative strength since October, and that's important because it tends to lead the market. We have not talked about Applied Materials, which is an equipment manufacturer, which we own, which gets its revenue from around the world. But for companies that are trying to expand their production, they need to buy equipment from Applied Materials. And Palo Alto in the security space, another key position, just made a rare five-year new high and had a great week this week. So we're there. The problem is you just can't focus in one group. We need to see participation from other parts of the market. So let's go from there. We talked about industrials for quite some time, a low in June, an equal low in October, but then a series of higher lows. And again, a pennant formation that formed up over the period of March through May. We broke out to the upside about 10 days ago and moving smartly higher. We are now at a level we haven't seen since the beginning of the bear market, basically erasing the bear market in the S&P. Now, the industrial space includes aerospace, which of course is the defense group, and that group has been strong. We've talked about that for a while. But it also includes machinery, and we've talked a little bit about this group. This is the Industrial Renaissance ETF. It's a mid-cap, an ETF made up of mid-cap industrial machinery companies, making new highs, in fact, new all-time highs. And we believe that the reshoring trend in the U.S. has only just begun. And there's a lot of companies that are levered to the U.S. that can really benefit. We've seen a big move in the companies selling equipment into the power grid in support of EVs. And specifically, we talked a little bit about ATS automation, one of our favorite positions. Fitting equipment would be another large position, trading better than 87% of all the companies in the S&P, seeing rising relative strength since July of last year, trading recently at a new 52-week high. Ingersoll Rand in the US, large cap name, $25 billion industrial company that sells around the world, but a big winner on any reinvestment in industrial machinery. And a couple of smaller companies like Atcor, which sells electrical and mechanical products into non-residential construction. And again, a lot of inexpensive companies trading at relatively low multiples with great opportunity in this reshoring opportunity. So industrials as a group, really important to see the equally weighted industrials ETF outperforming the market cap weighted, it means that the average stock is actually acting better than the industrial sector itself. So lots of opportunities there. Not so recessionary to see these industrial companies making new 52-week highs. Let's move on. Materials. Now, materials have been a difficult place to be over the course of this year. From March through June, this group backed up. But a couple of important points. First of all, since we saw the lift in the Russell 2000, this group has rallied 11% off the lows. But a more important stat is that since the beginning of the bear market, at the beginning of 2022, this group is up 2.8%. So it may have been somewhat front-end loaded, but the fact that this group, materials, have held up, again, through such a voracious Fed rate cycle, tells you that there is an underlying theme here of relative strength. And again, this is a group that a lot of people have bet against, and there's a lot of great companies. So we've talked about tech resources. We talked about Cameco last week, which continued higher this week, 5% higher. But companies like Vulcan Materials and aggregates that are used in construction and road building, trading better than 88% of companies, trading at new 52-week highs for the year. On top of some of the big setups that we really like in tech resources, this week we heard they've received a number of bids for their coal business, and they were able to hold off Glencore in their acquisition for the coal business and the copper business. Steel this week, trading very close to the high end of its consolidation band. In fact, up 17% since the beginning of the bear market. Again, very unusual for steel to be trading up 17% against a bear market and a Fed tightening cycle. What is that telling us about what happens if the Fed cycle comes to an end? My guess is likely these can go a lot higher. So these, remember, are groups that have been out of favor for a decade. They are groups where management has been pushed by their boards to cut costs, not to spend on capital spending, to return capital to shareholders, to increase dividends and buy back shares. They're generating cash. They're generally very well financed and have very little debt. And if prices remain firm, they can make a lot of money. CNQ, Canadian Natural Resources, very, very long life asset with very high cash generation, very little need for major capital reinvestment. They paid down debt over the last few years. Again, we're coming toward the end of this pennant formation. My guess is probably results higher, but 25% higher than where we were at the beginning of the bear market. Outside of that, a bunch of other companies, Meg Energy as an example, again, trading 94% higher than where we were at the beginning of the bear market in January 22. So energy materials continue to look really interesting and have been remarkably resilient. They've demanded some patience, but the opportunity, I think, comes as the Fed cycle comes to an end. Let's move beyond that. One of the groups that's been in difficulty over the last number of months is financials. Certainly the XLF, which is a broad-based ETF of financial companies, certainly sold off into the March lows. We highlighted partway through March that bullish percent was starting to improve, and we got a reversal higher in the beginning of May. Since then, the group is up 7%. Now, we think about banks often when we think about financials, and we've talked about some of our favorites like JP Morgan, right, which is, again, resolving another one of these pennant formations higher, made a series of higher lows. But we've often talked about our favorite group within this sector being the insurance stocks. Fairfax Financial making a 52-week high today, trading at 7 times earnings. Industrial Alliance Insurance, again, largely property and casualty, but a diversified financial services company, trading basically at 52-week highs. And Element Fleet Management, which is a fleet leasing business, which is based here in Toronto, and again, performing really, really well against a difficult market. So lots of things to do in this space. Now, let's talk about the consumer. It has been a conundrum that home building and home construction has been as good as it has been, given what's happened in the world of mortgage rates. Now, the reality is in the US, people have 30-year mortgages. They don't want to give up that low-yielding 30-year mortgage, and a lot of homes for sale. Also, there are a lot of families that were formed during the pandemic, and a lot of them starting to decide they want to buy homes. We focused in the earlier stages of homeowners. Our key positions would be Pulte Homes, making new all-time highs. They build homes in 42 markets. They focus in mid-priced homes around $500,000 each. They're focused in the South and the Southwest, trading better than 96% of companies in the S&P, and D.H. Horton, which also is single-family detached homes, and again, trading at new highs. So I understand the pessimism that is out there, but there are definitely things to do in this market, and it is not just tech. Tech makes up a significant portion of the index, and we probably are not going to be overweight tech, given that some of these other groups are underowned and unloved and reasonably priced, and showing some very, very good relative strength versus the market. I think it's important that consumer discretionary companies relative to consumer staples, or offense versus defense, is showing 3-month highs in relative strength. That's positive. Groups that we have generally avoided: consumer staples continue to be weak on a relative basis. Utilities relative to the S&P, weak relative to the S&P. So no change here. Telecom remaining weak, and REITs remaining around the bottom from a relative strength perspective. So this is still a market where we have to be targeted. We are getting through the transition that we have been going through since the low in October. We're seeing a broadening out across sectors and geographically for the equity asset class. We're seeing resilience in commodities, basic materials, and energy against what has been a very difficult Fed rate hike cycle. We have to look forward. Where people have been purchasing heavily positions in bonds, consumer staples, cash, and utilities, and sellers of U.S. equities, insurance, industrials, banks, materials, where people have been short the S&P 500, where people have built record positions in bonds. I mean, as big a bond position as we've seen since March of 2009, I think those folks have risk. Dividend growth is showing us clear outperformance versus bond proxies, high dividend paying defensive stocks. This, we think, is where we need to be to fight inflation. This is where we think we need to be ahead of the crowd. People are going to want to see a rising stream of dividends or cash flows. High beta companies versus low vol. You would think, given the concern about the economy, low vol would be outperforming. It just isn't. Again, since we saw this reversal in breadth, we saw higher low, sharp move higher in high beta stocks. So I think that our positioning continues to reflect the truth in the market. We have a significant weight across technology. We have an outsized position relative to the index in financials, a significant overweight in industrials, a significant overweight in energy, a significant overweight in materials. We have increased our position in consumer discretionary recently, and we do still have flexibility in that we have about 6% cash across the firm. And then in our balanced account, we have some government bonds, and we've got some corporate bonds, largely shorter term, where the yields are really attractive. We are underweight utilities, real estate, consumer staples, and communications. We think we're in a reflationary environment. We think inflation is coming down, but certain groups have the ability to set price. And we think that's going to be very attractive. Ideally, we'd like to have a portfolio built of dividend growers, companies that are paying us a rising stream of cash flow, and we want to stay in tune with the general fabric of the market. Last couple of points: Canadian dollar. Canadian dollar's been in a range since September. Today, it looks as though we are resolving higher. That doesn't hurt that the US dollar is weakening, but the Canadian dollar has been the strongest currency against the US dollar over the last 6 months. Volatility continues to be weak. Credit risk continues to be suppressed. We continue to be in a structural bull market. So we don't want to wait until there is some all clear sign that tells us it's time to be positioned. We're positioned. We know that transitionary periods where there's chop and a lot of negative feedback in the press is a difficult time to be invested. But the opportunity is to be in the market for the 2, 3, and 4 year runs that come in between cyclical bear markets. So we'll continue to watch for signs that things are getting more difficult. We'll continue to watch for signs that the groups that we're focused in are not working. And we're going to continue to try to identify new opportunities. This week, we initiated a new position in the TMX Group, the company that owns the Toronto Stock Exchange. After 3 years of going sideways, it broke out to new highs. It's got a 2.4% dividend and growing the dividend at greater than 10% over the last 3 years. We think that might be a market signal in itself, the shares of the exchange breaking out to a 3-year high. If things get difficult, we'll have no problem getting defensive. But frankly, at this point, we think we need to be positioned to try to take advantage of the next 3 years. So with that, I'm going to see if there's any questions. And forgive me if I fumble this a little bit because I don't do this a lot. Okay. Since some weeks, the Canadian market seems to lag a lot versus the US market. Volume's been weak. There's been not a lot of action. Any idea what's going on? I think, frankly, the Canadian market has underperformed because sort of April, May, there was weakness in materials and energy. I think that the Canadian banks also suffered to some degree. Mid-cap space looks interesting. We're seeing a pickup in the materials, which I think is a change. We're seeing a change in the Canadian dollar, which would be aligned with Canadian dollar tends to do well when global stocks do well. And I think that as we get through the concerns around the Fed rate hike cycle, we could see some relief. I think that the 25 basis point hike by Bank of Canada was in some ways a surprise, and that probably shook some folks. But my guess is we're going to see energy hold in here, and we're going to see some strength in basic materials. The Canadian real estate market, remains a question mark, something that we're going to have to watch. But my guess is we start to see it improve. Breadth is not as good in the Canadian market as it is in the US market, but I know that we got a lot of great Canadian positions. So I think that's going to be something to watch. Question here on gold, and let me just see if I can share a chart with you, because this continues to be one that is difficult. Let's see here. Okay. Share. Okay. So let's put up the chart in gold. Let's start with the very long-term picture. So this has been a question of patience for folks. Heard an interesting comment today. Jeffrey Gunlock, who has a view that there is appetite waning for treasury bonds. We've seen a lot of the biggest players internationally who have historically been owners of treasury bonds become sellers. And with the weak performance and negative performance coming from bonds, losing a bunch more buyers, that there could be some real risk in the treasury market. And if that's the case, you're likely to see some strength in precious metals. If we look at the long-term chart, this is a significant cup and handle formation. It's a very long-term chart. This is 2011. This is 2023. It's 12 years. We traded last month, a month before last, up above this channel. And if we move it down to sort of a short-term perspective, you can see that we broke out and have come back and rechecked the top end here. I know that this is testing people's patience. But that being said, it's a very, very bullish price pattern, and I think one that probably requires some patience. If we see the Fed pause the rate hikes, I think we could well see this start to lift. Higher rates are tough on gold, investors. There's opportunity cost. If there's a better opportunity to take money and put it in a treasury bill for some folks at a higher yield where there's no yield in gold, that's going to cause some folks to do that. But I am very bullish on this space. I think that it sets up very well. If you were to look at what happened to gold in that period where the US dollar weakened around the time of 2000 through 2010, look, gold rallied sharply for a decade. So, patience is difficult. But my guess is, like some other areas that have had these very large bases, we are slowly, one by one, seeing them resolve higher. And so my suggestion is probably a little more patience would be suggested. But I know it's not easy. I recognize that. I don't think that we have any more questions. If you're too shy to ask in the webcast, don't hesitate to reach out to us by email. My email address is dburrows@barometercapital.ca. I'm happy to answer. If you want to reach out through Twitter, we're regular on Twitter. We put things up pretty consistently at Barometer CA. And if you're a client, pick up the phone. Happy to talk at any point in time. I know this is a trying time for folks, and so ask away. And with that, I guess we'll call it a day. We'll be back again next week on Tuesday. I hope you're finding these useful. If there's things you'd like me to discuss that we're not, please give us the input. And thanks very much for tuning in. Hope you find it useful. Bye, folks.